Investment Outlook 2021. My name is Teck Wee, co-chairperson of NUSS Intellectual Pursuit and Lifelong Learning Subcommittee, and I'm delighted to be this evening's moderator. Before we start, I did an analysis of the stock indexes of various exchanges in Asia and US over the last 11 years. So I found that this is an interesting trend. Basically, it's about a lot of random performance, and it's pretty difficult to predict what is the outcome of investment outlook. So I would consider this to be more like fortune telling or Russian roulette. So the most recent year, which is the COVID year, we found that the annual performance of stock indexes in the region as well as the US have been quite interesting, especially after the major pandemic. Of course, we wanted to benefit all our listeners. So basically, we bring on board this panel, which is an interesting lineup, we hope, that will benefit your investment planning the year ahead. Okay, we welcome Professor Jamus Lim. He's an Associate Professor, Economics Department of Assoc, Asia Pacific. Jack Wu, CFA, Director Content Development, APAC CIA Association. Shadin Wong, CEO, Elite Commercial REIT Management Private Limited. Walter Wee, Chief Investment Officer, King's Group of Companies. And Daryl Tan, CFA, Head of Transportation and Logistics Coverage, APAC, ABN AMRO Bank, and of course myself. It is our honor to have 4 gentlemen and 1 lady with us this evening to share from their professional perspective on the investment landscape, on how we can evolve and in an era of unknown precedents. Before we begin, we seek your cooperation to answer the 4 questions which appear on the screen from time to time so that it can help the panelists to gather their thoughts and to analyze accordingly. Okay, let's put our fingers to work as we flash the first 4 question. 4 question, please. Please select your profession or the industry you're in. Are you a financial professional or are you in other industries? This is always a usual KYC question when you decide to sign up an investment account with any stock exchanges. Right? So they have a better understanding whether you are an accredited investor or you are just somebody that buy on other people's news. So can we have the results? No. So we can actually see that majority are actually not in the finance and investment arena, or they are not holding such positions. Okay, so most of the attendees are actually in a non-finance or investment role. All right, so house rules before we begin. All attendees will be muted throughout the session, and those who wish to answer questions anytime during the webinar, kindly click on the Q&A icon on the bottom of the screen. Keep your questions brief. We will address as many questions as possible during the Q&A session. Okay. Our first speaker, keynote speaker, Professor Jamus Lim, is an associate professor of the Economics Department in Assoc Business School and a nominated member of the 14th Parliament of Singapore, representing Sengkang GRC. Previously, he was the chief economist of the Third Rock Group, an investment management and wealth advisory firm. a lead economist at the Abu Dhabi Investment Authority, overseeing economic inputs underlying tactical and strategic asset allocation for the sovereign wealth fund. And prior to that, a senior economist with the World Bank, where he led initiatives on macroeconomic forecasts, along with analysis of trade, finance, and governance issues in East Asia, Middle East, and Africa. His research expertise and interests lie in the intersection of international macro finance, political economy, and development economics. And his work has appeared in leading academic journals such as Journal of Monetary Economics and Journal of Money, Credit, and Banking, along with policy flagships such as the World Bank's Global Economic Prospects and the joint IMF World Bank Global Monitoring Report. May I now invite Jamus to take charge of the screen. Jamus, please.
Thank you, Tegui. I'm just going to quickly see if I can share my screen here. Alrighty. Good. So thanks for taking some time out of your midweek and sharing that with us. So what I'm going to do is I'm going to try to set the stage a little bit for the subsequent presenters to come. I'm going to approach the presentation mainly from an economic perspective, in particular an international macroeconomic perspective. And I'll try to give you a sense of where we currently stand in terms of the international economy, together with perhaps some insight into where we stand in terms of Singapore relative to these international economy. So here are a few takeaways, just in case we run out of time. The few takeaways I want you to take away from this is, first, that the world really is in a particular stage of recovery. It's an anemic recovery, but this is in some ways to be expected. And the reason for this is because even prior to the pandemic recession, I'm going to call it the pandemic recession, we knew that a recession was already kind of in the cards. We had many indications of this. For those of us that have been observing financial markets for some time, you may have heard talk about this thing called an inverted yield curve, just the idea that when long-term interest rates are lower than short-term interest rates, it tends to be a signal by the market that they think that a recession is going to be on its way. And so, although the trigger for this recession was the pandemic, it was something that we didn't expect. Nevertheless, the world economy was already in a particularly weak window, if you will. Now, that said, it's not all bad news, in the sense that double-dip recession, so the idea of a economic contraction followed very rapidly by another one, is actually quite unlikely. In the history of the modern US economy, for example, you only have one incident of a double-dip recession. And even though these are more common elsewhere, like Europe has seen more instances of a double-dip recession, by and large, the sense that I have is that most of this rebound in economic activity worldwide has already been realized. And although the recovery will be slow, it's unlikely that we'll see another dip, even if we do see a resurgence in coronavirus cases, as we are in fact seeing in Europe and the US at this time. And the flip side of this is that, and this is the positive news, is that right in March of last year, there were concerns that the world would face a deflation scenario where prices would actually fall and perhaps go into negative territory. And now that is pretty much off the table. And but for those of us that have also been in observers in markets for a while, you'll know that in 2019, we talked about a divergence in terms of the way that the world economy was going. So we had developing economies at the time, emerging economies, growing relatively faster, and advanced economies relatively slower. And the sense I get from how the data are playing out is that 2021 will see a return to this possible divergence theme. So in the slides that they're going to follow, I'm going to sketch out this storyline that I've just drawn out for you with a number of charts. So the first set of charts I'm going to show you are indicators for four main relatively high frequency. And so we're talking about the macroeconomy. So the frequency of data in the macroeconomy is pretty much measured in months at the fastest. So I'm going to show you measures of production, employment, income, and sales. So this is global industrial production broken into three main categories: emerging market, manufacturing-oriented economy. So think of economies such as China in this case. Developed markets, which are more manufacturing oriented. So you can think of this as the Europes and the Japans and the United States of the world. And then commodity exporters. So these are the Australias, the Canadas of the world. And if you look carefully, you'll notice that actually the rebound has really only been realized, at least in terms of production, in emerging economies that are manufacturing oriented, right? So that's the gray line. If you look at the other two lines, you'll see that in developed markets, manufacturing in developed markets, the rebound is only part of the way, has only made part of the way back to where we used to be. And then if you look at commodity exporters, at least in the latest data, there's even the possibility of a slowdown in the recovery. So that's production. What about another measure? So employment is another measure that people often look at. And here, if you look at the four major, what we call the G4 economies, so the Euro area, the United States, United Kingdom, as well as Japan, you'll see that what unemployment, from essentially the post-global financial crisis period up till the pre-pandemic period, you'll see that it was steadily on a downtrend. So this is obviously positive. More people are getting more jobs. But what you see is that as a result of the pandemic, we saw a tick up in unemployment. Now, this wasn't that large in most of the developed markets. The reason being that there were a lot of welfare programs that supported employment. The exception here was the United States, where the nature of their welfare schemes requires that you actually report unemployment. So you saw a huge surge there, but even in the United States, you've seen that after the depths of the recession in March and April, that has pretty much come down. Now, the other thing you'll notice, of course, is that it has come down, but it's still elevated. So unemployment is elevated relative to the pre-pandemic period. And while we have not reached the levels that we saw at the heights of, or rather the depths of the global financial crisis, nevertheless, we are seeing elevated levels of unemployment. Two other measures. One of them is incomes. And what do we see there? Well, incomes have fallen. This is a sampling of emerging markets, the so-called BRIC economies, Brazil, Russia, India, and China. And what you'll see is that with the exception of China, which has pretty much seen, I wouldn't say a full recovery in disposable incomes, it's seen a significant bounce back in incomes, but that isn't the case for the other major emerging market economies. As you'll see, they are pretty much hugging zero in terms of growth. And then finally, what do we see in sales? Well, here, up till recently, sales was the one indicator that kind of held up. And there are good reasons for that. One is that while we're all stuck at home, we were all doing online shopping and so on, and we needed to continue to eat. So sales numbers actually remain elevated. But the other reason is that there were a lot of packages that were supportive of continued retail activity on the part of consumers. So what essentially happened was they moved from essentially going to the stores, physical stores, to actually shopping online. And what you'll see is that this huge bounce back essentially in retail sales after the kind of the most severe lockdowns that happened in March and April, right? So you see that in the G4 economies, advanced economies. But you also see that bounce back actually in the non-commodity emerging market economies, so the Koreas, the Chinas, and the Mexicos of the world. Now, so what were policymakers doing during this time? So policymakers acted very decisively with the two main tools that they had: fiscal and monetary policy. So fiscal policy is government spending, and here you see a summary of the massive expenditure packages that the G7 economies, so the advanced economies, the developing economies, as well as closer to us, ASEAN economies. So as long as governments had some ability to spend in order to support their economies during the most severe of the downturns, they did. And Singapore is no exception. We spend about 20% of our GDP on our fiscal package, tapping also on national reserves. The thing is that unlike Singapore, most other economies did so from a relatively weaker position in terms of their reserves. So what that meant is that a lot of them had to borrow. And what this means is that it leaves behind this legacy of debt. And you see this legacy of debt, especially for emerging markets, because they were not able to, they don't have the same ability to tap into low-cost financial markets for the purposes of stimulating their economy. So they essentially had to borrow. And what you see here is that this legacy of rising debt, so in the chart, it's total debt worldwide by the three major sectors, right? Government, corporates, as well as household. And you see that this has risen inexorably. There was a slight decline in debt numbers, at least on the government level after the global financial crisis. But you see that essentially the world is more indebted than it's ever been as of the latest data in 2020, in mid-2020. Now, what about monetary policy? Well, all around the world, there was very limited action that could be done. So the reason is because interest rates were already not that high. So what you'll see here is policy rates. So these are the central bank interest rates. They rapidly slashed it, right? So you see in advanced economies as well as developing economies, many central banks slashed it. In advanced economies, they essentially slashed it close to zero. And in developing economies, they cut it significantly as well. Because remember, inflation in emerging markets tends to be relatively higher. They run in the order of 3 to 4%. So in real terms, meaning that if you take away inflation from these nominal interest rates, you'll see that essentially interest rates were also very low in real terms in emerging markets. So what did central banks do? Well, they went to the unconventional monetary policy toolbox, this thing that you may have heard of called quantitative easing. Essentially, central banks started buying other kinds of assets. This could have been government bonds. It could have also, in some cases, as it was the case in the Bank of Japan, the purchasing of corporate issued debt, as well as some forays into stock market purchases. So central banks all added to the size of their balance sheet in order to keep money flowing as easily as possible, given that the conventional instrument of the interest rate was no longer available. Now, the risk, of course, that many suggested was that inflation could actually take off. But if you look at inflation numbers, you'll see that it actually remained relatively contained. So this, what you see here are what's sometimes called five-year forward. So this is the expectation in financial markets of what inflation is going to be 5 years into the future. And as of the latest data, which I collected, which is sometime in December, at the end of November, you'll see that essentially the market does not expect any runaway inflation, with the exception of the United Kingdom. That's because the pound has been very weak of late. You'll see that inflation expectations are essentially very, very close to official central bank targets. And in some cases, as in the case of Japan, below central bank targets. And if you look at the actual data, you'll see that likewise, realized inflation has remained very low. So median inflation in developed markets is actually close to 0.5%, and median inflation even in emerging markets, which historically has been much higher, something to the order of 4%, is actually also quite low. It's something closer to 2% right now. And if you look at pressures for inflation, so the main pressures of inflation tends to be emanating from commodity prices, and in particular, the prices of energy, oil and gas. And you'll see that while it is the case that agricultural prices and metals prices have picked up, in fact, energy prices have not. They're no longer as low as they were in the depths of the pandemic crisis, but they have definitely recovered substantially to what you see today. So I'm going to wrap up with a slightly longer run theme, and that is, well, where does that leave us? Well, we are in an anemic recovery, as I suggested, but the pandemic has led to some long run changes. And one of those is an acceleration in this process where the world is undergoing a retreat in all its traditional international integration measures. So one of this is trade. You'll see that there has been some retreat in terms of international trade between countries. If you look at financial flows, which were already in retreat since the global crisis of '08, there's very little sign of recovery compared to the '07 and '08 period. If you look at international tourism indicators, so this was one of those international flows that had remained relatively stable prior to the crisis, but as we all know, stuck in Singapore, tourism indicators everywhere worldwide has also essentially collapsed. International travel, international migration for the purposes of work has also collapsed. And the one measure that has remained robust, as the very fact that we are having this Zoom meeting attests to, is the fact that information flows have remained strong, and if anything has accelerated as a result of COVID-19. So the world is in fact starting to show signs of fracturing toward this process of multipolarity, right? Where you'll see regional giants, China, Europe, Western Europe, as well as the United States. And this fracturing of the world into this multipolar world actually looks set to continue into the future. So what does it imply for an investor? Well, the other panelists will have more to say about this, but essentially the big message is that we see a disconnect between this macroeconomic story that I just painted for you, and of course financial markets. For those of us that have been looking at financial market indicators, we see that financial markets have actually run ahead of themselves. In my view, is that it's likely to resolve in favor of the fundamentals, so we're going to see much more muted gains in 2021. But what this divergence in performance also suggests to us is that you might want to, as an investor, maintain exposure to certain well-managed economies. And the obvious suspects in this case has been East Asian economies, which have performed relatively better as a result of the pandemic crisis. And if you look at companies, of course, companies that are better positioned to take advantage of this regionalization and multipolarity trend that I suggested to you, they will outperform, as will those that have embraced digitalization and that are better able to integrate digital operations or rather digital activities into their operations. And in terms of Singapore economy, can thrive as long as it transitions toward emphasizing the ASEAN hinterland rather than its traditional emphasis on serving the international investor. And then, of course, closer to home, we really have to make sure that our small and medium enterprises raise their productivity. There are lots of government programs designed to help toward exactly that purpose. And the idea is that we want to transition our Singapore economy toward a focus on ASEAN and toward raising the productivity of even our smallest firms. So I'm going to stop there and let we take over, and I'll stop sharing my screen as well.
Thank you, Jamus, for the very insightful sharing. Before we proceed to the next speaker, may we have the next poll question? Okay, this question is mainly related to investment landscape. Which of the investment asset class are you most interested in for 2021? Okay, you can take as many as you want. Is it stocks, futures, which is a lot more risky, bonds, which is supposedly for more risk-averse investors, precious metals and gold, or real estate? Okay, can we have the findings of the poll? All right, so we can expect that the majority of our listeners would dribble into stocks, which is readily available and probably easy exit for most of us. Interestingly, there's no interest in futures, supposedly much higher returns. There are some interest for the conservative who will decide to go with bonds. Right, there are some who are interested in more exotic or alternative investments like gold and precious metals. And of course, the old money will go back to real estate. Interesting. Okay, as we proceed to the next part of our discussion, I'd like to introduce our next speaker, Jack Wu. Jack serves as Director of Content, Asia Pacific at CIA, where he leads the research, creation, and development of knowledge in the alternative investment space. He's also responsible for executing the organization's content strategy and CIA's charter program curriculum. Prior to his CIA role, Jack was an investment professional at the fund management house, Credit Suisse and SC Capital Partners, where his focus was on real estate. He has completed over $800 million of direct investments across Asia Pacific markets and various real estate types. Jack has also worked at GIC, where he completed investments in both private equity and real estate space. Jack holds the CFA designation. So without further ado, Jack, I leave the mic to you.
Thanks, Tegui. Yeah, hi everyone. Glad you can join us this evening. Let me just share my screen and all right, and I can get started. Okay, so after the comprehensive presentation by Jamus on the macro environment, looking at the key economic indicators, my portion will touch on the investment environment. And often these two are kind of like two separate systems. In the short run, they might be going in different directions, but over the long run, they should trend and be reflective of each other. So for my portion, I will touch a little bit about the historical perspective of the investments records. I will also touch a bit on the different asset classes so that you can get a sense of their relative performance. And finally, I hope to leave with you with some tools and concepts that you can consider when you think about your own investment. So let me start at a very high level to talk about asset class performance as measured by indices. So this chart, it's basically showing you the past 10 years performance records of the different asset classes. It's very colorful, but you should just focus on three groups. The green, which is basically your equities. The yellow, which is your fixed income. And finally, the orange, which are basically your private markets, which is your infrastructure and your real estate. And if you zoom into year 2020, you can see that generally 2020 was a really good year for the equities and somewhat a good year for the fixed income, not so good for the private markets and commodities. But if you also focus on the rightmost column where it's on annualized 10 years record, you can see that equities has been performing really well with 14% for US equities, while private markets kind of range between a 7-ish%. Bond markets are pretty decent, while commodities in the last 10 years has not been performing that great. And zooming into fixed income, in 2020, fixed income basically benefited from the declining interest rates and also investors search for yield. And all these tickers that you see here, these letters, they are basically the tickers of ETFs that tracks the underlying fixed income type. So on the leftmost, basically you have your safest fixed income, the US Treasuries. In the middle, you have your US corporates, both the big corporates and also the medium-sized corporates. And finally, on the rightmost column, you have the international fixed income. I will just touch a bit more on the US Treasuries. Historically, on a whole, they would perform somewhere, say 1 to 8%. But as you can see from the chart, for 2020, they really perform super well. Next, returns to equities. For equities, again, the breakdown is Americas is on the left side, while you have your Asia Pacific in the middle column and your Europe on the rightmost column. What you will see is that most equities perform well, but not all. So there are still some equities market that are still below the level where they were at the start of the year. So I will touch on Americas first. On the leftmost column, you can see that at the very top is your CCMP, which is basically your Nasdaq Composite Index, and Nasdaq is basically tracking the largest tech companies listed on the US exchange, and the index performed over 40% in year 2020. The other two major index for the US markets are the S&P 500, which delivered about 15%. And this are basically tracking the 500 largest company in the US. And finally, you have your Dow Jones, which is indicated, labeled as INDU, which delivered about 6% return. And Dow Jones are the largest 30 or so companies listed in the US stock exchange. So you can see basically equities on the whole performed well, but the outperformance was really concentrated in large part in the tech stocks, in the tech story. In Asia, turning to Asia, you can see that for Asia, Korea and China, Korea represented by KOSPI and China represented by the Shanghai Shenzhen 300 index also were top of the rank in terms of performance-wise. Whereas for Hong Kong, represented by HSI, and Singapore, represented by STI, did not have such a great year. And finally, just to round out, for Europe, you can see a lot of the major indices are still kind of below where they were at the start of the year. So now that many of the equities market are at all-time high, as you can see on a historical basis, Nasdaq on the left-hand side and S&P 500, and also for Asia stock markets, Shanghai Shenzhen 300, and also the Korea KOSPI index. With these markets at all-time high, what are your options now? And actually, other than price index, the other consideration is that on the PE, the price to earnings ratio, they are also at their historical high in the top end of their historical range. So basically what that means is that valuation-wise is also at a very high range. So as pointed out by Jamus earlier in the presentation, that economy is still not quite fully recovered, but as you can see, the financial markets are kind of ahead of the economic recovery. So this disconnect is kind of terrifying for investors. And what should you do with your money? What should you do with your current investments? Now, it might sound a bit cliche, but the prudent investor try not to time the market. But you can adjust your allocation between the different asset classes. And so let's look at the other investment landscape as well. So we spoke about equities and fixed income, but that's on the public markets, and that's considered on the traditional asset classes. There's another group of investment, which is considered the alternative investments. Essentially, that's everything that's not stocks and fixed income. And for alternatives, the universe is actually much wider than the traditional asset classes that the retail investor will know, such as hedge funds and gold. There are also private equity, real estate, and infrastructure. Now, if you compare the use across the asset classes, you can see for equities is represented by the green bars, fixed income by the blue bars, and alternatives by the gray bars. Alternatives actually offer higher income yield, and they also offer diversification because their returns driver are somewhat different from the stock market, public stock market, and also your bonds. But it comes at a cost because they are highly illiquid investments. And other than the landscape, I will touch on the investments trends. Some of the big trends that you should be aware of is that COVID has certainly accelerated trends. So we have sustainability trends, digital trends, and localization. For sustainability, companies are really talking about carbon neutral and talking about higher costs for some businesses that are not environmental friendly. And on the flip side of it, on the positive side of it, is that there are also emerging companies that are providing green solutions, and these companies should do well in this environment. The next is on digital, and you can see that a lot of tech companies are doing really well in these current times. And the tangible assets, the heavy assets, such as real estate and infrastructure, are not as valuable as before, but rather the intangibles, such as IP rights, such as your technology, are getting more valuable. And lastly, on the localization trend, is basically playing on the same divergence theme that Jamus spoke about. Basically, countries are getting more multipolar, and there's on top of that, there's also a need to do greater resilience into your supply chain. So instead of offshoring a lot of your supply chain and your production, there's a reverse of that trend to onshoring, and this will translate to a whole set of different opportunities. The next big trend is on the private markets. On private markets, there are three things that you should be aware. Number one is that a lot more companies are privatizing. So in the US, for example, the listed companies peaked around 7,000, I think, a few years back. But now the number of companies are probably around 60% of the peak. Second is that more companies are actually raising money from the private markets than the public markets. And what this means is that if you only invest in public stock markets, you're actually losing out on the opportunity to participate in the growth of all these private companies. And lastly, on the private companies is that a lot of these companies are at the forefront of innovations. For example, companies like SpaceX, which is basically changing the landscape for space market, launching rockets into the orbit. They are a private market, and the space business is actually estimated to be a US 1 trillion market by 2040. So all these companies, they are actually private, but most investors, they are not able to participate in innovative companies like those. I will skip the other two big trends. I think they are self-explanatory, but I will talk more about the low interest rate environment. So for the low interest rate environment, what you should know is that, as pointed out earlier, a lot of the development markets have very, very low interest rates. And that's because the government is trying to stimulate economic growth and prevent deflation of prices. And you can see in the chart on the left-hand side, all those in the red, they are basically sub-zero bond yield. And even for those with those in the greens, you can see that for the short term, for those 1 to 3 years, they are basically close to zero, with the exception of China and India. So what this means is that bond yields are really at an all-time low. Interest rate is very low. The other point to take note of is that there's estimated about 17 trillion US dollars in negative yield bonds. And this is estimated to be roughly 1/4 of the investment grade debt. And in fact, if you raise the hurdle a little bit higher to 1%, it is estimated about 3/4 of the investment grade debt is actually yielding less than 1%. So what does this mean for investors? From a portfolio perspective, historically, you have your 60-40 portfolio where you have 60% in stocks and then you have your 40% in bonds. So what that does is been very effective. And what that does is that when the economy turns and stock prices drop, you have the backstop of interest rate cuts and your bond prices will increase to kind of offset the negative impact on your stock portion. But now with interest rates at the all-time low, you basically will not enjoy that, you enjoy very little of that benefit, and it would not be as effective in terms of giving a diversification effect to your portfolio. So you need to think about what are the other ways that you can protect your portfolio and diversify. The other implication that you need to think about is income. With the low interest rates, if you're buying bonds with sub 1%, investment grade bonds with sub 1%, that's going to yield very low income for you. So what is happening is that a lot of investors are switching over to other asset classes, such as real estate. They are also going up the risk curve, such as going after the high yield bonds. And also for more aggressive investors, they might even take on leverage for their fixed income. So what this does is that basically a lot of people will be yield hunting. Finally, the last implication you need to think about is that it's pretty much a risk-on environment right now. You have your equities market at all-time highs, and at the same time, IPO figures for last year in the US stock market was also at a record. There was over 400 companies that IPO'd, and this was even higher than the year 2000, where you had the dot-com era. And also at the same time, you have a boom of retail investors, where the retail investors, there are a lot of retail investors participating in the stock market for the very first time. So on the other hand, you also need to think about there's a lot of capital that's still in the negative yield and in a very low interest rate environment. So what will happen if some of this capital, some of this money decide to move into the riskier assets, and this will definitely change the structure of the markets. Finally, before I hand over to Teck Wee, I just want to leave you with 3 things to bear in mind. This is kind of like a checklist that I do for myself. So before you take on any position, it's definitely prudent to weigh estimate your risk and your upside. And of course, if the upside is meaningfully bigger than your risk, you can take it helps in your position sizing. But of course, if the downside is higher, you got to think about waiting for the next opportunity. Next, you have to think about whether the asset class is overcrowded, and I will put it in 3 categories. One is if it's really overcrowded, you have a lot of people in the same position talking about the same investments. That's generally a bad idea to chase those investments. The next category is that you have asset classes where it's under allocated. So these are for example, value stocks. For one is they are sort of not as crowded as growth stocks, the high-tech stocks, and you are still able to find large cap stocks that give you good dividend. But the problem with them is that they are often not as exciting, and they don't offer gains overnight. but over the long term, they should prove to be steady investments. The other area which is kind of under allocated that you can think about is China stock market. There's been some estimate that the foreign ownership for US stock market is roughly around 40%. But on the other hand, for China, foreign ownership, because of the structural restriction, is actually less than 5%. So if you believe that the China stock market, the China financial system is going to get integrated more deeply with the financial system like the US stock market, then it's an area that you can look into. Finally, always think about your horizon for your investments. Definitely, if it's going to be a multi-year, make sure that those money are set aside for that purpose. And of course, if you are making any investments, you can do your dollar averaging. You don't necessarily have to buy everything in at the same time. Now, with that, I wish you all the best. You'll be rocky waters ahead. And over back to you, Teck Wee.
Thank you, Jack. Thank you for setting the alarm bells. Right.
Okay, I'll stop share.
Yeah. So before we deep dive into the various asset classes, we'd like to bring up the next poll question. Okay, this is for real estate mainly. Over the next 12 to 18 months, will you consider to invest in REITs, the physical real estate related bonds, real estate related stocks, or basically you're not interested in real estate at all? Okay, bear in mind what Jack and Jamus have shared previously. So please choose your poison. Okay, so I think it's okay. Let's look at the results. Well, of course, Singapore is the best market for REITs investment. So we have half of our listeners voting for REITs. We'll look at REITs investment because of the high yield, or is it because of the conservative valuation? There are those who are still conservative and believe in the old asset class of real estate. Interestingly, only 1% decided to go into bonds. Okay, whereas a couple of people decide to go into stocks relating to real estate. And of course, the most interesting is that 1/5 of our voters decided that real estate is not in their game. Okay, so with that in line, let me introduce to all of you the next speaker, Shadeen. Shadeen is the Chief Executive Officer of Elite Commercial REIT Management Private Limited. As manager of Elite Commercial REIT, which is listed. She has over 20 years of experience in corporate finance, finance management, and investments. Prior to her current appointment, she was the portfolio director of Elite Partners Capital, principally responsible for the acquisition and operation of the Elite UK Commercial Fund. Shadeen also held various related roles in companies like head of projects at SMW Real Estate Management Private Limited, Group Director, Finance Director of China Huarong Energy Company Limited, a Hong Kong listed company, CFO at then SGX listed Pacific Shipping Trust Management Private Limited, and Head of Investment at SGX listed Cambridge Industrial Trust Management Limited. Shadeen, I hand the mic over to you.
Thank you, Teck Wee. And thanks everyone for joining us tonight and spend some time on this. Let me share my screen first. Okay, so after hearing from our previous presenter about the whole investment market and economic market worldwide, maybe let me come back to a little bit more closer to ground. I'll talk a little bit more about our Singapore real estate market and also our REITs market. So I guess locally, we have been very familiar with the real estate market in general, and people here in Singapore either invest directly into the properties, or they look at what is very popular, which is the REITs. So a little bit on the Singapore real estate market for last year is that the Singapore GDP has actually contracted 5.8% in 2020. And we see unemployment rates has been surging up as well. But despite the ongoing pandemic situation and the economic headwinds, the Singapore property market actually remains quite buoyant throughout 2020 in general. We do see a couple of new launches. We also see the increase in the number of MOP resale flats that came out in the 2020 year. So a lot of activities were ongoing after the second phase of the circuit breaker. And in general, for the entire of 2020, we do see that the property prices remains very resilient. The private housing prices increased by about 2.2% in the whole year, and the HDB resale flats actually rose by 4.8%. Now that the vaccine has actually been developed and is being rolled out, the likelihood of containing the pandemic has actually increased. But we, of course, do not expect that we will see the reversion back to the pre-COVID days in any time soon. But the housing demand in Singapore is likely to remain resilient in 2021. But of course, with the review of the uncertainty in the economies, sellers and also developers are expected to be a bit more sensible in their approach when it comes to pricing of properties in accordance to the market. So for 2021, the key trends that we will see in Singapore real estate, it's as follows. Mainly is that actually due to the COVID-19 pandemic, a lot of people are working from home. There is actually a shift in terms of the property buying habits in property investors that we see in the market. So buyers are actually looking at larger size properties, and they are actually also looking outside of the CBD area. So the suburban areas are also in demand. Now, the minimum occupation period market is going to continue to be buoyant as well. There is about more than 50,000 HDB flats to reach the MOP period within 2020 and 2021. So we will see a little bit more of a resale stocks coming up into the market as well. And due to the pandemic, I think the local buyers are actually dominating the market. More than 80% of the buyers in 2020 actually are local buyers, and these are actually more of home occupier buyers that we are seeing. So this will continue and expected to be continued in 2021. The government has actually also put in place the cooling measures about 2 years back. The government has also reduced the number of government land sales in this 2 years. So we are actually slowly seeing the possibility of en bloc sales coming back. The most recent one being in November, we do see an en bloc of 15 terrace houses in Guillemot Street. So it could be the situation whereby we'll still see a bit more of en bloc sales market. Now, as I think we have said earlier, or the previous presenter has also said earlier, we are expecting to see a lower for longer interest rates environment that's going to last. The SIBOR at the beginning of last year stood at 1.75%, and by December 2020, it's only at 0.25%. So this is expected to give a lower mortgage rate environment in Singapore. Now, coming to the other side of the investments for real estate, rather than the physical property, I think as REITs or Singapore REITs market has been around for many years, it is actually an alternative to physical real estate. It's more liquid, it's lower cost. It also gives investors the ability to diversify its baskets, and real estate properties that are being managed by REITs are actually being managed by more professionals, managers. So this has become a very attractive class of investments for Singapore investors over the past 18 years. Today, the Singapore REITs and property trust sector, it's considered as Asia's global REIT hub, or it's actually one of the most buoyant market in not only in Asia but also in around the world. So it is the largest REIT cluster in Asia ex-Japan with 43 listed trusts, and it has a combined market cap of more than 100 billion Sing dollars. That's about 12% of the overall SGX listed REIT market cap, and I think the sector actually contributes to more than 25% of the daily turnover on the stock exchange. Now, if you actually looked at how S-REITs has performed in comparison to the SGX, SGX itself, well, the chart basically looks at the STI index, how it has actually performed since the beginning of the year. During the start of the CB, we do see that the S-REITs has actually reacted, and it has actually decreased quite significantly. However, the rebound was much quicker than the STI index. So it has actually been overperforming the STI index since shortly after. Now, the S-REIT markets actually started back 18 years ago with the first listing. And at that time, I think most of the listed REITs are very much dominated in Singapore. It actually looks at just domestic properties. But today, 80% of the REIT list listed on the Singapore Exchange has actually got overseas exposure. So there is a diversification, not only in terms of the asset class that we see, the sector that has been involved in the S-REITs market, but also in terms of the geographical location. Of course, the pandemic has got impact on different types of asset class on S-REITs itself. Some are actually more affected than others. Particularly, I think the hospitality and the retail REITs are the ones that has got the direct impact due to the footfall and also due to the limitation on traveling. Of course, there are also sectors within the S-REITs market that has been less affected, or even looking at more buoyant than before. So, like the industrial has been stabilized. But you can see that due to the e-commerce and also a lot of electronic online buying and stuff like that, the logistic market and the data centers has been the darlings during this period of time. Well, maybe a little bit of thoughts before you dive into whether to invest in the REITs, I guess. The economic outlook determines also the sector that is of favor, and also whether you have the appetite for investing into that particular sector. The dividend yield and the frequency of the paid out is something that investors are looking at when they invest in REITs. These days, REITs are either paying out quarterly or they're paying out semi-annually. In the Singapore S-REITs markets, REITs are paying out more than 90% of their distributable income to unit holders in the market. Well, of course, at the back of these, the fundamentals of the REIT is that who are the tenants, what are the assets, what are the lease arrangements, how long are the WALEs. These are the key points that investors will need to consider before making an investment. Now, lease arrangements could be, there could be a master lease arrangements whereby if there's a very strong master lessee, then it could tie you over during a pandemic period. But if there's a weaker master lessee, that might be quite difficult for the REIT manager. And I think we do see some of the examples in the market today. Well, of course, the tenant base itself, the tenant base also has a very strong importance to how sustainable is the rental income. Now, the lease arrangement earlier when it says that other than the master lease, of course, there is also a tendency that in Singapore, we do see a lot of triple net leases. Now, if that's the case, then the tenant is going to take care of the building. The tenant credit rating is very important. Are they able to take care of your building even when market is not doing well? How is it being performing? Are they able to continuously pay their rent? How long is the lease period? I think these are key important points for investors to consider before making a decision. Now, the NAV, which is the net asset value of the REIT, and of course, fundamentally, who is managing it? Who are the sponsors behind the REIT? The strength of the sponsor and the experience of the manager will definitely give more confidence to the investors when it comes to which REITs to choose to invest in as well. So I guess that is my few pointers to investors when they're looking at investing into the AS REITs. Back to Teck-Wee. Yeah.
Thank you, Shadi. Thank you for sharing on and representing the REIT space. Before our next speaker comes on the screen, can we have the next poll question? Okay, this is pertaining to Walter's presentation. Okay, over the next 12 to 18 months, which of the following alternative investment asset classes will you be interested to invest in? Okay, you have choices like precious metal, excluding gold. Okay, you have a physical gold, paper gold, meaning trading in gold, cryptocurrency, which actually appears in one of the Q&A questions, and as well as maybe you're just not keen on alternative asset investments. Okay, please vote. Okay, can we have findings of the poll? Oh. Interesting spread of listeners who are willing to invest in physical and paper gold. Okay, though it represents a minority of 10% each. Cryptocurrency, the up and coming, including the lots of news of Bitcoin recently hitting $35,000. But majority of our listeners are actually pretty conservative, maybe, or they are not so aware. So, okay, with that, I'll hand over the mic to Walter, but let me present Walter. Walter is the Chief Investment Officer at King's Group. He manages a portfolio of assets with focus on Indonesia and Vietnam. The group has offices in the US and Singapore and valued at about $350 million US, valued by Credit Suisse and reported by Report magazine. He played integral roles in many merger acquisition transactions, and last year he forecasted and accurately achieved the gold price, which is current value, and today he forecasted the gold price to reach $2,500 for the year. Okay. Walter speaks regularly on radio shows based on gold-related investments. He's featured on Money FM, the Asset Magazine, Report Magazine, FX Traders, and many other media and publications. Walter is a strong advocate of savings in gold. So without further ado, Walter, I'll hand over to you.
Hi, good evening and Happy New Year to all of you. Yeah, so I'm just gonna go through, in layman terms, how gold is and how easy is it to save in gold. Like many people during the pandemic period came to us and voiced out that it was not easy to be investing in this kind of pandemic period, and whatever they touched lost money. So that being said, there were also stocks that made a lot of money, and we have a lot of questions based on cryptocurrency and all that. So we would actually, I will actually talk about gold, which is something that's closer to my heart. Well, to start off, of course, everybody knows that gold dates back thousands of years. The history of gold being having value has been especially important in Asian countries as well. In many of our important events, weddings, baby showers and all that, there's often exchange of gifts in gold. So that shows how much we value gold itself, right? Okay. Also going on to simple things like why is gold valued of value to us. So when you look at times like this pandemic, you would see in political uncertainty, gold prices have raised up pretty much steadily. And as much as the clients do ask us, so is it time to buy gold? It's so expensive. But I had clients asking me 5 years ago and then hitting themselves in the head why I didn't buy gold then, right? So gold itself is very stable. I wouldn't look at it as a form of investment, but I would also look at it as a more of a form of savings, right? Okay, so moving on to the second slide. Let me tell you, many people are asking how difficult is it to invest in gold itself. So on the second slide, let me see, Jocelyn, next slide if you don't mind. Yeah, okay, there we go. All right, so how difficult is it to invest in gold? It's not nuclear physics. There are several ways you can invest. Of course, you could buy physical gold, which is a gold bar itself. You could buy gold jewelry. Recently, very popular ETFs, gold ETFs, and then of course you could buy shares in gold mines and all that. So recently and very recent, there is of course this way that you can invest in gold, which is cryptocurrency, which is backed by gold. So that is relatively new, but as opposed to just cryptocurrency itself being a concept, I would say that yeah, it's also a possible way where you can invest it in gold, right? So right, let's go on to how we can maximize our gold investments. Uh, One way I do teach my clients is that you could always look at gold as a savings. And when you want to make an actual investment, for example, I have a stockpile of $1 million worth of gold. And right now I need liquidity because I want to go into an investment in a business. You could always go to some investment institutions right now and get liquidity of gold itself. So some of them may lend up to even 70% of value of the gold, whereby you actually still do have ownership of the gold, just that it's in custody. And then you could take this money that's being given to you and leveraging on it in doing your business and everything. So you would see that if gold price goes up, you're in there. And if you, of course, succeed in your business and then you make money from there itself, right? So one very big question that my clients would ask as well is, so last year you said 2000, not many believers, but it hit 2000. All right, and then this year, what's the price? Is it like 3000, higher than that, lower than that? My view is that in 2021 itself, gold is likely to hit the price of US dollar 2,500 per ounce. When and why, I can't say for sure, but I know that recently we've discussed this, and I think in the next 6 months we would see quite a big spike in the price due to certain reasons. One of the reasons is, of course, the U.S. market, right? Just a few months ago, there was elections, and a lot of uncertainty who's going to win the election. So with U.S. dollar being one of the main currencies in the market, everybody's concerned. So instead of looking at that, some of them turn to buying gold itself because it's stable, right? Okay. Another point is because of the pandemic. This pandemic has caused a lot of the economies to shrink, as well as to look inwards, like many of our speakers have mentioned. That causes actually a disparity, and instead of seeing unions coming together and having trade efficiently, having logistics chain getting smoother, you actually see the reverse, where you see countries blocking off each other. There's problem with logistics, flights don't take off, cost of freight goes up. All that causes a lot of strain on currencies and the economies overall. So many people in uncertain times do turn to gold. And then looking back at the pandemic itself, there's this talk of the cure, which is the vaccine coming up. Look at one of the bigger few brands, Moderna, Pfizer, you have Sinovac. And then you have news announcements that say, Oh, okay. My vaccine achieved so and so efficiency, and it's now going to uh, relieve the world of this COVID. And then the dollar stabilizes. You see gold prices stabilizing as well. But how true is that? Because we have seen this news announced and being disannounced when they go like, oh, we have quite adverse reactions, and then you see the price going down and gold going up. So if you ask my opinion, I feel that the COVID vaccine is not going to see the kind of stability that we would wish for, because just to the layman, right? Vaccines are not meant to be researched and you can't find a solution in such a short period of time. It's only being released because of necessity. So are we going to see this COVID go off? I don't think so. We've seen outbreak of different strains turning up. So with all this uncertainty coming along, I think gold prices are easily set to hit maybe the 2,500 range. Okay, so on to the third slide, right? The third slide actually looks at the future of gold. Where I've touched on why why people ask me why is gold prices going to hit 3,000 and all that. So I'm not going to play God, to say that the other asset classes are not good, the other investments are not stable. But if you look at the signs that are coming up, I think the 3,000 mark is even possible. All right, so lastly, let's go on to the last slide. Wait, where's that last slide? Okay, yeah, that's right. Just to summarize, right? So is buying gold a good investment? With most advice that I give people, don't put all your eggs in one single basket. Diversify your investments. Gold, to myself, right, or to many people actually, is not a bad investment because that being very stable, if you're willing to keep the gold itself for 2 to 3 years, I'm definite that you see a upturn in the price itself. However, like I said, don't put all your eggs in one basket. You don't have to overexpose yourself to a single asset class. Look at different ways that you can invest as well. Gold also has many different ways that you can invest. So besides physical, you can also look at ETFs, a little bit in shares in a gold mine. Yeah, so that being said, I'm happy to share my views on gold. And let me hand you back to Teck Wee.
Thank you, Walter. Maybe now some more of believers in gold after Walter's presentation. Okay, before we go to our final speaker, let's have the last round of questions. 4 questions, please. Okay, Daryl will cover on the credit risk assessment angle. So describe your personal risk profile. Are you willing to lose all capital in exchange for high returns? Okay, or are you the kind that you're willing to take moderate risk and willing to lose certain amount of your capital, but not too much? Or maybe you are a fixed deposit investor, just put money in the bank and not think about what will happen tomorrow. Or even worse, you are not a believer of financial institutions. You decide to keep money in your pillow or the biscuit tin, as we mentioned, as we prefer to say. The last one will basically be the economic decision. Maybe today you want to invest in gold, then tomorrow you decide, say, okay, how about other investments? Okay, fickle-minded. So please take your claim. And results, please. We have 3 out of 4 of the listeners willing to take certain risks and willing to lose out of up to 1/4 of your investment money, which is interesting. Okay, no risk, no return. Right, a low risk, low return, high risk, high return. So I think that's fair enough. There are 5% of those who are big time speculators, which is good. Probably you make big money. There are some who are still believers of banks and willing to take below 1% fixed deposit interest, 4% not believing in anybody but yourself. Right, and of course there are also 4% who cannot decide. Okay, interesting. So let's proceed to our last and final speaker. Prior to that, let me introduce Daryl. Daryl is a managing director and head of transportation and logistics coverage team for Asia Pacific at ADM Enro. He has 20 years of experience in the finance and maritime sectors. As a sector coverage banker, Daryl led mandates ranging from cross-border tax leases, acquisition finance, capital market advisories to asset-backed finance transactions for clients. He has concluded transactions in many countries within Asia Pacific, with deal volumes exceeding $5 billion US. Daryl is a CFA charter holder, and he has interest in fintech. Recently, he completed a fintech course from Harvard while working from home. Now, we invite Daryl to take the mic. Daryl, please.
Thank you, Tekwi, and good evening, everyone. It's never easy to be the last person presenting after such a strong lineup of speakers and speaking so close to 9 p.m. in the night. So I hope everyone can bear with me for the next 5 minutes. Having heard about the economy, the investment landscape, different asset classes, I would like to now share with you some insights into the global credit situation in 2020, its impact on the fixed income market, and the outlook for 2021. If we could just go to the next slide. Yeah, so thanks, Jocelyn. In 2020, global debt to GDP continues to increase. So, and according to the Institute of Global Finance, the global leverage had moved from a high of 232% in 2019 to a record 365% in 2020. Well, part of this increase is a result of increasing debt taken on by sovereigns and by corporates and households. The other reason for the increase in debt to GDP is due to the stark reduction of GDP across board as a result of COVID. Not surprisingly, with the increased leverage, weaker cash flow and earnings, it results in a general deterioration of financial health and outlook of corporates. And that also results in negative credit rating for many companies. Downgrades for most rating agencies were actually at an all-time high in 2020. S&P or Standard & Poor's alone reported over 2,000 negative rating action on its rated companies. And it's expected that more negative rating actions will carry on into 2021. You see corporate credits diverging as well. There's a differentiation in risk and recovery path with different industries. Consumer-focused sectors like telecoms, utilities, consumer staples were actually very resilient during COVID. But the affected industries like aviation, travel, oil and gas were really badly affected. The less affected industries rebounded quickly, and industries like aviation, we all think that recovery will take years. And unfortunately, central banks and governments reacted much faster this time during this pandemic compared to the global financial crisis in 2008. Several waves of government stimulus ensured that the banks and debt capital markets remain open and there was sufficient liquidity going to companies to support the businesses, which was something lacking during the global financial crisis, where banks were actually tight on liquidity, and that result in a lot of shock in the financial markets. What is also very interesting to see this time in 2020 is that with major pandemic shocking markets, there's an increased awareness towards ESG. I think Jack mentioned it briefly in his presentation that it's one of the themes to look out for. And we have seen in 2020, much more capital have been allocated to fund green projects. This year has seen definitely a growth spurt for green bonds, with the market heading towards the 1 trillion milestone. We expect this trend to continue and likely accelerate. We move to the next slide. Yeah, so the credit condition in 2020 has made fixed income investments relatively challenging, and bond investments have gone through a volatile period as a result of the pandemic. Even prior to 2020, interest rates in the major economies have been falling over the last years as a result of monetary policies by the various central banks to try and stimulate economic growth in the various countries. However, COVID had definitely pushed central banks to take more drastic emergency intervention, and that has pushed interest rates to its lowest points in the last years. Fed funds rates in the US is now between 0 to 25 basis points. ECB already had negative interest rates in 2019, but yields again face more downward pressure in 2020. With bond investments, there are now less options if you like to find good yield investments. Jack had mentioned earlier as well, now there's an estimated 17 trillion bonds outstanding in the market, and these 17 trillion bonds are actually negative yielding. So that's slightly over a quarter of the bonds in circulation. Just giving some examples, the Greek bonds today is trading around 63 basis points. I checked that today. Spain is around 3 basis points, and debt on Ireland is minus 32 or negative 32 basis points. And many of you may remember not so long ago in 2015, Greek government bonds were trading as high as 19%, and today it's at 63 basis points. So yields have definitely fallen massively. Of course, one could argue that the health of the countries are different, but the reality is now we are in a low interest rate environment. Unfortunately, it's not expected that the low yield environment will change anytime soon. Having said that, there are definitely still opportunities present. There are still bond instruments that provide higher yields. For example, high yield US corporate bonds has an average yield close to 5%. Asian high yield corporates trading close to 3.5% on average. Of course, higher yields will also likely mean higher risk. Well, we briefly mentioned it earlier, and one should always tread with caution. There's also corporates that will be improving credits as a result of the improving economy, and spotting some of these good companies can also provide good investments. So we move to the final slide with the credit outlook for 2021. The outlook for 2021 is definitely more optimistic, although an uneven recovery would be likely. Jamus mentioned earlier in his presentation, he talked about an anemic recovery, but also divergence in recovery. And I think that divergence is not just with countries, but also with industries. Certain countries are expected to recover faster. For example, China has already started on a recovery track in 2020. Stronger US corporates have already started to delever their balance sheet as of third quarter 2020, and that is likely to continue as the economy improves. Certain sectors like telecoms, utilities, software, which were largely immune from the pandemic, will see their balance sheet improving rapidly. Interest rates, unfortunately, expected to remain low, as most, if not all, the global economies will continue to keep their policy rate low. This will, in some ways, help corporates, as there will be lower interest costs, and it allows companies and sovereigns to strengthen and hopefully recover over time. It's also expected that countries will continue to have supportive fiscal and monetary policies, although this will likely phase out as economies recover. But that will also mean the search for yields will continue to be difficult. While some of the economies and sectors will improve, certain sectors will continue to face headwinds, and it's expected that credit downgrades will continue. Standard & Poor's again says that the corporates and governments have a 36% negative bias. So defaults are also more likely to happen, especially if debt moratorium, which was one of the feature in 2020 as government stepped in to help the companies and businesses. If the debt moratoriums are stopped and government support are slowly phased out, this will likely result in more defaults in the market. We think that the credit outlook for 2021, there will be a common theme of greater focus on green sectors. BlackRock has famously quoted that climate risk is investment risk, and they are putting a lot of their investment assets into green sectors. We expect to see a lot more investments moving towards that, and companies and projects that are focused on that transition would definitely stand to benefit. On the other end of the spectrum, we think that companies that lack in sustainability may actually find reduced interest from investors and may find it more difficult to attract liquidity. So I think investors should definitely keep an eye on ESG and sustainability as a theme going forward. But to summarize, I think the outlook for 2021 looks much more optimistic, but the market will continue to be volatile. Having bonds or fixed income can provide ballast to a healthy portfolio, and definitely one that investor should take into consideration. But with that, I end my presentation and I hand the mic back to Teck Wee. Thank you.
Thank you, Daryl, for your insights. And we'd like to welcome the panelists back on the screen. Now is the last segment of our discussion. It's a panel Q&A session. We have a couple of questions on the screen so far. Let's start with questions for Daryl. With the market and the economy in a disconnect, from a credit standpoint, what would be your recommendation on what to look out for when you invest?
Yeah, thanks for the question. When I look at the financial health of a company or do a credit analysis of a corporate, it differs depending on the industry, the size of the business, the stage the company is in. But typically, very generically, you look at a few metrics, both financial and non-financial metrics, to determine the credit strength of the company. So non-financial metrics would include things like the industry risk and outlook, and the country risk where the business is in, the competitive position of the company, their strategy, corporate governance, capital structure, access to capital markets, for example. I think if you look at, say, REITs or real estate, as Xiaodin earlier mentioned in her presentation, that when you analyze a company, you also look at the quality of the assets and the quality of the sponsor. So if you're looking at the sector, that's also something that you would consider. For financial metrics, you would look at things like liquidity, leverage, profitability, cash flow, and interest coverage ratios. These are, well, I'm just quoting generic metrics, but the analysis of financial ratios actually really depends on the industries that they are in. A conservative leverage ratio for the commodities industry is very different from one in the real estate industry. So it's important when you do an analysis or look at credit of a company, you also benchmark it to their peers as well, so that the ratios or the analysis, the numbers that you churn out from a calculation makes sense. I think what's also important to consider is when you do an analysis on the credit strength, you shouldn't just base it on a time period, but you should also look at it over, say, a time scale of 2 to 3 years, so you don't base your decision on a single time frame. So that's how I would look at it.
Okay. So a question mainly for Jamus as well as Jack. There's a disconnect, as both your slides have mentioned, between the stock market as well as the real economy. Please comment.
Jack, do you want to take that first, or do you want me to take it?
Oh, Jamus, please go ahead.
Okay, so I get asked that question a lot. The first thing that to keep in mind, of course, is that it's not, and this is not just the case today, but worldwide over history, the connection between the performance of the economy, at least in the short to medium term, and the stock market is actually quite low. So so-called correlations between these two, if you just do a cross-sectional correlation, you'll see that the correlation is extremely low and sometimes may even be negative. So that's the first thing to keep in mind. That said, in the medium to the longer run, of course, stock markets ultimately must reflect the earnings of firms, and earnings of firms in turn must reflect the overall performance of the economy. Now, setting aside complications, there are some complications, of course, like, you can imagine living in Singapore where companies often have exposures to sales that's abroad. So, obviously there's going to be a disconnect in terms of the performance of the company in which it's based versus its the overall profit stream for that corporation. Now, but I think that the biggest reason why you see stock markets performing so much better is simply because stock markets are forward-looking, and they have essentially priced in a lot of the so-called outperformance that we would expect from having the pandemic. We saw this, in fact, if you think back just to what happened in SARS. The stock market found its bottom pretty much at the depths of the SARS crisis, and then essentially pretty much bounced back. Now, the most recent pandemic crisis is, of course, relatively more severe than what happened during SARS, which essentially lasted only 1 quarter and didn't even show up at all in the macroeconomic data for that year. But the pandemic crisis obviously will show up in the data for many countries for the full year. But more importantly, because the stock market acts as a forward-looking mechanism, it would already have factored all this in. And the other very complementary explanation for this is something that the others have mentioned, Daryl and Jack and others, that basically with interest rates being as low as they are, stock prices essentially are discounted by interest rates. So, it's in stock prices essentially reflect the interest rate in the denominator. So when your denominator is going to be a lot smaller, then naturally prices must be a lot higher. So I guess I may have touched on 3 or 4 reasons why there's actually a disconnect. So you can take your pick among them.
Yeah, I will just add a few points to what Jamus has mentioned. The first thing is the disconnect between the economy and financial markets can go on for quite a while. It can go on for as long as 1 to even 3 years or 4. One will never know when the disconnect will actually correct and normalize. So I think it's definitely prudent to say that you wouldn't, even if you think that markets are at all-time high, you wouldn't necessarily short the market because markets can go irrational for a very long time. However, definitely you'll be very cautious and look out for signs that would normally trigger your flight to safety. But the good news is that this disconnect is a different degree for different markets. I would say as a whole, my personal view is that the US stock market, the disconnect with the fundamentals is greater. But for the other equities market or for the other markets, the disconnect might not be as great. Hence, therefore, the risk is not as high. Yeah, Tegui, back to you.
Okay, sure. We have a question pertaining to real estate. So I guess it's for Shardeen. As mentioned previously on a lot of slides, the real economy is basically not turning out as well as it should be, and tenants are likely to exit their leases. So what's your perspective from a REITs manager standpoint?
Okay, I guess yes, in situation like that, especially if you talk about the creditworthiness of the tenant is very important. So, which in such a situation whereby there are chances, and we do see in the market that tenants are actually trying to get out of a building, it will actually cost the income for the owners to be affected, definitely. It will take time for you to get another new tenant in as well. And there could be also, depending on how much cost you need to upgrade the building or you need to add into the building. Hence, actually, when you do look at investments, that is an important factor to look at. If you're looking at physical property, the areas and also the tenants that you're getting in the first place, it's very important to see where, to ensure that they can actually pay the rent. And I guess that's where the REIT market is very attractive, because the REIT market actually is managed by professional managers, and they will assess the creditworthiness of the tenants. So when you look at investing into REITs itself, look at the background of who are the tenants, who are the users of the building, and of course the creditworthiness and also the experience of the managers. That will help in the case of investments into the REITs. Of course, the WALE itself, which is the weighted average lease to expiry, the longer it is under this current market with a strong tenant, will ensure that there will be continuous rental payments to the landlord for a longer period of time, and also within the lease period. Yeah.
Okay. We have another question, which is I would say is for Walter, and maybe Jamus and Jack can jump in. Cryptocurrency has been the favor of the season for various reasons. Bitcoin has reached highs of $35,000, and now there's mentioned that gold is the underlying asset behind Bitcoin. So where does gold stand in the investment space these days?
Yeah. If you don't mind, I just start first, right? Okay, so yeah, cryptocurrency definitely very controversial there. For our take is cryptocurrency has seen a lot of movement upwards in terms of its price because of the clampdown by the banks, by many of the central banks, to say that we don't want to take cash without proper KYC, without proper source of funds and source of income. So that has caused a lot of panic and a lot of the not as bankable industries to turn to cryptocurrency itself. And of course, with supply and demand, then you see the same thing, Bitcoin or other cryptocurrency prices going up. With Bitcoin being tagged to gold, I don't really see that as something being a norm. However, if you say that there are cryptocurrencies that are backed by gold, yes, definitely there is an increase of that, so that there is provenance, there is some form of a backing to cryptocurrency itself. Yeah.
Yeah, so I'm not a cryptocurrency expert, but I think I'll just add that there's three things that you should know. One is Bitcoin is one of the many cryptocurrencies. But it is kind of considered the reserve currency of the cryptocurrencies. And that's because the market cap of Bitcoin has gotten so large. I think it's over 50%, maybe to 70% of the whole market cap of the cryptocurrency landscape. Second is with Bitcoin, there's no underlying value. It is really a matter of who will pay a higher price for Bitcoin. So it's a matter of scarcity, and it's really hard to determine the value of Bitcoin. So therefore, it's really I don't have it for my personal investment. Finally, you must know that with cryptocurrency as a whole, is not regulated generally. So therefore, there's it's different when you compare with the other asset classes.
So excellent points by both Walter and Jack. And the only other things I'll add is that I think cryptocurrencies have found, in particular Bitcoin, have found a niche in certain institutional investor portfolios, mainly the same kind of niche that gold often holds in institutional portfolios, which allows a certain kind of hedging, especially when we think that they're going to be weak fiat currencies, especially as the questioner had asked, weakening in the US dollar. That said, cryptocurrencies, the big risk in cryptocurrencies here really is ultimately one of being crowded out by an official digital currency that will be issued by, say, a central bank. Yeah, the Fed might come up with an e-dollar, and the Monetary Authority of Singapore is also exploring the possibility of e-Sing dollar, for example. When these kind of electronic current digital cryptocurrencies come out, they will, just like regular currencies do today, play a bigger role in as reserve currencies in portfolios, and depending on their design and their ability, of course, they won't have the same kind of built-in scarcity value that Bitcoin does. But if, there's the regulatory risk, if, the regulators simply say we will not entertain exchanges between our currency and cryptocurrency, then you immediately collapse the market, and it will be left between the shadow economy participants to be able to engage in cryptocurrency transactions.
Okay, I'll pose 3 questions to all of you. So in a sentence, describe how you think 2021 will pan out, number 1. Second question, if you have money, where will you invest in? And finally, what is your advice for investors right now? So let's start with Daryl, then in descending order.
So thank you. Your question is, the first one is in a single line, the outlook for 2021. Is that correct? Okay, so then I would say a recovery, but a volatile and a rocky landscape. And was the second one, if I have money, where would I put it? So I would go with what Jack has said. Actually, it's now actually a risk-on mentality, and also interest rates at a low level. I would actually put, well, I think that should still be an allocation, and I will put a larger part of my assets towards equities, and some of it in fixed income and potentially alternative investments. And what was the third question again? Sorry.
What's your advice for investors?
Yeah, understand your risk.
Okay, Walter?
Yeah, okay. For 2021, I think it's going to be actually just as interesting as last year. However, looking forward, we have all learned how to deal with it. So I think, like what they mentioned, the new norm is change. So looking forward, I think the economies will be able to stabilize better. However, the COVID pandemic, the uncertainties there will be, I think, one of the biggest denominator changes. Yeah. If you ask me, where should I put my money? That's hard to say, right? being an advocate of gold, of course, I would advise in gold, But like what I always tell most of the people, do diversify. If you're not sure, then it's always better to wait and see. Having cash on hand, sometimes cash is king. So then after looking and taking a step back, you can always make a better decision to where you can invest your money. So that also goes to the advice I have for the investors. Yeah.
Jadine?
Okay, I guess pretty much in line. I do believe that 2021 is still going to be a challenging year. Although we are starting to see that, it could be a recovery, but it's going to be a long drawn one. It's not going to happen overnight. So what I can say is that I guess in terms of investments, people have to be very cautious, has to really look at it carefully before you make a decision on what to invest in. If you ask me what I could invest in, I agree with the approach of diversification. As REIT market, the property market does have its charms, and it still has its potential, especially in the Singapore market. But having said that, the equities markets, the bonds market, and also, of course, some cash in hand is always good as well. So if you ask me, I would look at a more diversified portfolio. For investors' advice, I guess, to share with everyone, do be patient. Look at and understand what is your own risk appetite. How long is your time frame that you can hold on to your investments before jumping into doing an investment, rather than doing it speculatively and regret later. So do some research, do understand the investment type before making the decision. Yeah.
Okay, Jack.
Yes, thanks. Yeah, so for 2021, I echo that it's going to be a challenging year. Economy-wise, it's going to be recovery, but it might not be as strong as we hoped. For markets-wise, I think a lot of things are priced to perfection, so one will definitely have to be cautious. In terms of where I would invest my money, I think the concept of diversification, it's important. And if I really have to put money in a certain area, I will put it into innovation, companies that are trying to solve problems. Sustainability is one of the theme, and I spoke about others during the presentation as well. Finally, as to the advice, I would say risks and the investor's time frame, these are important considerations in making any investments.
Jamus.
All right, so I'm going to be consistent here and say that my one sentence is going to be divergence. So that obviously, with all its implications, where I would invest, obviously, the context is that I am, a mid-40-year-old with, I don't know, a life expectancy with a slightly longer horizon. So for me, it would lean toward a greater propensity toward risk. So 70-30 kind of portfolio, maybe even an 80-20 portfolio, 80 geared toward, and here I like most academics, I would say, put it in a diversified global index, so a stock MSCI World kind of index for your 80% and 20% globally diversified bond index. It could be 70-30 depending on your risk profile. And the advice for it, I think that wraps up my advice for investors as well.
Okay. Thank you to our panel of the speakers. Ladies and gentlemen, we hope you enjoy this webinar. Before you leave later, please give us a quick feedback on the poll. We look forward to see you in future online events. To look out for our e-newsletters to members. If you have any questions, feel free to drop us a message. Thank you so much and have a good evening.
Thanks, everyone.